Good morning, Prabhdeep bhai.
Hi, morning, good afternoon, good evening, everyone. Thank you for being here today, and I extend my warm welcome to each one of you, and a special welcome to our esteemed speaker, C.A. Satya Bharath. Today, we have gathered here to speak to understand IFRS 18, which is the need of the hour. If we look at any project of IFRS foundation, it normally takes a decade, and that has happened with IFRS 18. If we look into the 7, 8 years ago, the IFRS foundation had been specifically looking at two projects. One was this IFRS 18, which changes the face of financial reporting, and the second one is management commentary project. Now, this IFRS 18 has been issued. It will be applicable to all the companies, and when we look at management commentary, the work had significantly advanced, but in the recent times, because of the alignment with the sustainability standards, the project is going little delayed. But if we look into the history of management commentary, it did not started a decade ago. It started, in fact, I would say close to 2 decades ago, because that was the year 2010 when the IFRS Foundation had released the practice statement, which was not mandatory for the companies. It is expected that with management commentary project being implemented, the face of the financial statements will further change significantly, because there will be a lot of information which the financial statements will have to have for the users to take decisions and make it easier for them. So now, without further ado, today we have our speaker, Satya Bharath, those who are from UAE, and those who are from the southern part of India. They don't need an introduction for who Satya is. I have been seeing Satya for the past few years, the way he has been spreading the knowledge in UAE through different forums. And today we are that esteemed audience who are getting an opportunity to have 1 hour with him. So Satya, is a chartered accountant, practicing chartered accountant, and an expert in IFRS standards, in taxation, and in many other areas, taxation and IFRS standards. I see his core areas, and happy to see that many members from the Telugu community, those who are based here in UAE, have joined today to encourage, to support their own brothers from their own place. And thank you, Satya. Thank you for being here. Before you officially go on and start your session, and I hand over the screen, is there anything you would like to share? Say right now.
Yeah, it's good. Good afternoon, everyone.
Yeah.
So we'll straight away go to the topics.
Yeah. Okay. Thank you. Thank you, Satya. So the screen is yours, and please
Sure.
move ahead. Thank you.
Hope my screen is visible now.
Yeah,
Yes.
yes.
Yes, Satya.
Okay, thanks for the confirmation.
It is.
And I'll try to keep it more interactive so there will be more questions. I request everyone to answer, use the chat box to the maximum extent. And How many of you are?
Satya, maybe you can be a little louder. Just
Okay.
little.
Okay. How about now? Is this
Yeah.
good? 1 second. Otherwise,
No, now it looked okay.
it's
Now
fine,
it's
right?
Yeah,
Okay.
yeah.
you are audible, pretty much audible. Yeah.
Great. Thank you. Thanks for the confirmation. And myself, Satya Bharath, I'm a CFA, FCA, ACM, and FTA tax agent, and I represent DSB Chartered Accountants. And as you all know, today's the hot topic IFRS 18, which is closely almost 90-95% convergence, also having with IND-AS 118. Previously, it was IAS 1, where we have the presentation of the financial statements, but then now this is upgraded version of it, presentation and disclosure in financial statements. So, and addition, there is a slight changeover in the name. So let us see what IAS. Uh, there is an echo. 1 second. Hope is there any echo still or how it is?
Everybody has to unmute better.
Yeah. Okay. Mr. Muralidhar garu, can you please unmute? Can you please mute? Fine. Now, earlier, so these are all the paras that we have in the IAS 1 presentation of the financial statements, starting with objective financial statements and till 140 paras, there is no application guidance or anything. As you all know, IFRS 18 is applicable from 1st of January 2027. So FY 2027 only we should be worried about the presentation in the new format. But then it requires to have the comparative as well, meaning for FY 2026 also we should be prepared, not that we are bound to prepare our financials of 2025 or 2026 in the format given in IFRS 18. So Murlikar, can you please mute? Fact. Sorry for the disturbance. So the paras that you can see on the screen with the blue color font have been moved to IAS 8, and the one that you are seeing in the green color have been shifted to IFRS 7. IFRS 7 is for the financial instruments for the disclosures part. And then the one that you are seeing in the black font majorly retained in IFRS 18 with certain deletions, revisions, and major overhauling. So if you see the whole paras, how it have been shifted. So IAS 1 become adopted into three different paras. Two paras have been shifted to IFRS 7 with certain major paras have been moved to IAS 8, which was accounting policies changes in accounting estimates and errors that got changed. Even the name of IAS 8 have been changed to basis of preparation of the financial statements. So the whole structure will be effective from 1st of January 2027. Having said that, when we are preparing FY 2027, the comparative of financial year 2026 should also be prepared in the same format of IFRS 18. And also we need to provide the reconciliation, because now financial year 2026, when we finalize the audited financials, we will still stick to the IAS 1 format. Going forward from FY 2027, we will shift the style to IFRS 18. So obviously, the way that it is presented in 26 and 27 comparative of 26 will have a difference. So we need to provide the reconciliation as well. In the first year, we need to provide the reconciliation as well for 2026. Hope I'm clear. You can see the red highlighted are those paras that got deleted completely from IAS 1 when they are shifting to IFRS 18. The one in blue color highlighted is got a major changeover in IFRS 18. Plus, there are some more add-on paras. There are more emphasis given to the aggregation, grouping, and the disaggregation policies, and the style of statement of P&L and other comprehensive on how got completely changed over. Certainly. Early adoption of IFRS 17 is acceptable, absolutely correct. So the early adoption is have been given. If you want to follow even for FY 2025, FY 2026, you can follow. But we need to mention specifically in the notes that we are following an early adoption of IFRS 17 have been taken. Otherwise, early adoption is absolutely allowed. Good to go. So IAS 1 paras have been moved to 3 different standards, majorly been moved to IFRS 18. Some portion also been taken by IAS 8, and the IAS 8 name have been changed from accounting changes in accounting estimates and errors to basis of preparation and financial statements.
So IAS 1 will be still applicable even after implementation
No,
of.
it is completely got repealed effective from 1st of January 27. IAS 8, IAS 1 will not be there.
Okay.
See, as and when you buy a books, there are 2 sets of books available from the IASB, International Accounting Standards books. They generally sell 2 style of books. One is the required, one is the issued. So required is the one. For example, if you buy 2026 version required, you can still see IAS 1. But then if you buy the issued, so they have already repealed. The IAS 1 is no more applicable effective from 1st of January 2027. Clear? Fine. Then now let's understand the structure of it. Statement of financial performance. Previously, we used to call it as statement of profit and loss and other comprehensive income. Now the renamed as statement of financial performance. However, the flexibility is always given, be it in IAS 1, be it in IFRS 18. The naming of the statement is always a flexibility given to the user, meaning you can call it as an income statement, you can call it as a profit and loss statement, you can say it as a statement of financial performance, statement of profit and loss and other comprehensive income. The naming is up to us. There is no hard rule that we have to stick to that particular format. Okay, so what is a major change now? We have to, previously we were presenting in a different style. Let me show the way how we used it to do previously. Okay. So the screen is visible, right? So we were having statement of P&L. Can someone please confirm? Is
Yes,
my
yes.
writing visible?
Yes,
Yes.
Yeah, thank you. Thank you. So statement of P&L and other comprehensive income. So these were the first statement, number 1, and we were preparing the statement of financial position, and we have statement of changes in equity and statement of cash flows followed by notes to accounts. So these are all the requirements for IAS 1. For statement of P&L and OCI, the presentation used to be, we have the revenue and we have the cost of goods sold or the direct cost, gross profit less expenses. Expenses you can classify either based on the nature of it or based on the functionality of it. The nature such as sales expenses, purchase expenses, function like employee cost or even marketing distribution cost. So based on the function you can bifurcate or based on the nature, either of it, it's a choice given to us. Then we have the profit before taxes, tax expense, profit after tax. And if you follow single statement approach in the sense, like in the very same statement, we will continue with OCI items. So OCI, non-reclassified to P&L, reclassified to P&L, and we have our total comprehensive income. Or if you want to go for the dual statement approach, all this portion will be under one statement, the P&L portion, and OCI portion, we will have a second statement. So, but most likely we follow single statement approach, most of the companies. Fine. Okay. Then statement of financial position, there is no change like the way how it was previously. You have your current assets, non-current assets, total assets, your equity share capital, other equity, non-current like current liabilities or non-current liabilities, everything is intact. And statement of changes in equity, your share capital, other equity portion, revaluation reserve, fair value, foreign currency translation reserve, fair value reserve. So everything will be covered in statement of changes in equity. Statement of cash flows as per IAS 7. Notes to accounts. What are all the components in the notes to accounts? We will start with the legal owner details, the company status of company legal status, owner details. We will have the basis of preparation. Under basis of preparation, 4 points we will be including, starting with the Financial statement is showing the fair and faithful representation. We are following IFRS. If there is any deviation, we are going to mention over here. We are following going concern basis. We are following accrual basis. All these things will be mentioning, followed by significant accounting policies, and we have your accounting material, accounting estimates we will mention, and finally capital disclosures. So out of the 5 statements, like the way how we use it to present in IAS 1, where the changes that have been brought in by IAS 18, IFRS 18, is this the way that we need to present our format. So this is the major. And in the balance portions, it is only about the aggregation and disaggregation. So what are all the components we need to very clearly mention? I mean, with more disaggregation rules and aggregation rules they have given. Otherwise, the format wise, they didn't disturb much. The same format, the style is exactly the same way how you are presenting your balance sheet. You call it as a statement of financial position or balance sheet, either way. It's completely it's up to us. Whatever the name we want to give to the statement, we can give it. We can call it as a balance sheet as well. Statement of changes in equity, the format is same. Statement of cash flows, almost the same. There is no big change. The one other change what they brought in is management defined performance measures. So this is the one change they brought in for the notes. So these are the major components. Fine. So this will be our discussion going forward. We are good to go. Again, can you take the questions at the last? I prefer to take it so that we don't disturb. The flow would be good. Coming to the management defined performance measures, this is not a mandatory for everyone unless the management, say for example, they are using in out of the financial statement, say for example, this is a listed company and they have to give a management commentary or maybe a kind of any other document they are providing to the users, and that having some kind of information like adjusted profits, EBITDA, or maybe any some other totals or subtotals they are providing, which is not currently covered by the IFRS 18. If these subtotals are not covered by the financial statements, the format given by IFRS 18, then the management is bound to have this management defined performance measures specifically covering the respective total subtotals or the jargon that they are using in a different documents apart from the financial statements. Clear? So this is not a mandatory. This is mandatory when the management issuing a separate note to the bankers or maybe to whomsoever they are using, they are issuing, and the totals, the amounts that they are using is something different, which is not currently presented in the financial instruments, financial statements. Okay, so we'll take up this on priority. Our next, the entire webinar will be covering only on the SOPL, the format, and the way how we need to present. So they have given, we'll be starting the statement of P&L, just like the way how IAS 1 allowing us to have a single statement approach. We can have both statement of P&L as well. Statement of P&L as well as statement of statement presenting the comprehensive income, meaning OC items in the very single statement. Or we can go for the dual statement approach. Dual statement approach, meaning a separate statement for the P&L and a separate statement for the OCI. When we prepare this, whatever the P&L, the closing balance of the first statement will be the opening balance for the second statement. So this is how it will be presented. So just keeping it next to next, there will be no change except that there is one separate statement is created for the OCI items. Our discussion will be limiting to the single statement approach, as this is the way how we generally use. Okay, question 1. I have to have operating category number 1, followed by investment category. So operating category, the second investment category, third financing category, income tax category, and discontinuing the operations, discontinued operations category. So total 5 categories we have. And this is a pretty old one, OC items, the way how we use it to present as per IAS 1. So this is super easy. They already identified various international accounting standards, international financial reporting standards, have given the list of items when an OCI item should be considered and whether it will be reclassified to P&L in the future or not. So this is a positive list. Already they have given what are all the items should be covered in this list. So this is intact. There is no change at all for this. Only the change is in previously we used to club everything in the style. For example, there is an expense based on the nature of expense. We use it to aggregate as per IAS 1. But now we need to present whether that expense should be under operating category. Under operating category, you can aggregate, but whether that expense should be part of your operating category, investment category, financing category, income tax category, or this. So this is the first decision we need to take. So to understand that, we'll check each category wise. Can someone tell me what are all the incomes and expenses do you think the operating category will be having? What kind of incomes? You can use the chat box for now, or we can have an open Q&A at the end. I would like to have your answers for the income and expenses, cost of goods sold. Okay. What other kind of income and expenses do you think the operating category will be having? Premium income. Okay. Fine. The answer is super easy. Those, okay, before that, I'm sure OCI, everyone is super clear. There's a fixed list of items. There is a fixed list of items which will not be reclassified to P&L, 4 items, and reclassified to P&L, there are 7 items, total 11 OC items. For now, I just mentioned only 9, but then there are 2 more from IFRS 17, which I have not shown here. Even those IFRS 17 items will be part of those reclassified to P&L. So this is a very fixed list. We all know it. Our interest is only understanding what item should be under operating category, investment category, financing category, income tax category, and discounted operations. Income tax category also we all know, because this is just go blindly as per IAS 12. So IAS 12 has given a list of expenses in income which should be part of your tax expense, like the way how it was presented tax expense previously. Now we use the income tax category. So the incomes and expenses in this category will be flown from IAS 12. And for the discontinued operations, we have to refer IFRS 18. IFRS 5. So IFRS 5 has given the list of income and expenses that will be part of this category. So now we are not interested in income tax category, discontinued category, or OC items. Our focus will be more onto the operating category, investing category, and financing category. Hope it is clear. I repeat, there are total 5 subtotals. There are 5 subtotals. Our P&L going forward from 1st of January 2027, we are going to have 5 subtotals. What are the 5 subtotals? The first one, all the operating category profit and loss will be the first subtotal. The second one is your operating profit and loss plus your investing category income and loss will be added together and will be presented as profit or loss before financing and income taxes. So this will be clubbed and shown as a second subtotal. So the name itself shows that it's before the financing and income tax category. Then all the income and losses or the financing category would be added. This will be our third subtotal, followed by income tax. This is like a PBT, if you all remember, like profit before taxes. And then we will be reducing the income taxes. We'll have profit or loss from continuing operations. And then after discontinuing, this is the final profit and loss. On top of this profit and loss, we will also consider OCI items, profit and loss plus OCI items together. We name it as comprehensive income. Then the first one we are discussing now. So the answer is quite simple for the operating category. All those items which are not classified under the rest of the four categories will be falling under operating category. So it is basically a residuary category. Now let us shift our understanding to investment category and financing category. So once we know the income and expenses, if it need to be fitted, if it need to be presented under investing category or financing category, it should not be part of operating category. So it's more like a residuary. So we have to work more onto the investing category, financing category. Income tax category, anyways, we know as per IAS 12, and discontinued operations should be from IFRS 5. Yeah. Where to present taxes on the discontinued operations? So we'll be presenting in the very same, so like a net of taxes will be taken.
So depreciation will be operating category, right?
Depreciation will be operating category. Yeah. So we'll be going to, so depreciation, before we say depreciation should be an operating category or not, we will now see what items will come under investing category and financing category. The moment they are not fitting under any of those four, it is obviously has to go to the operating category. So this is like a last bucket. If it is not fitting under any other category, we'll be taking it over there. So now let us start working on the investing category. Any idea what kind of items should come under investing category?
The dividend received from investment in
Okay.
equity,
Anything more?
then
Interest
interest.
income, deposit income.
So let me take some of the points like interest income, dividend, anything more? Do you think?
Then this one is the exchange of trade expense, mutual fund, bond, like that.
Rental income from the investment properties.
Okay, great. Anything more?
Equities, in essence, equities and the mutual fund.
Yeah. So capital appreciation, capital gains on the equity mutual funds. Okay. To make things easy, so let us take the whole balance sheet. Our investment category, depending on your assets. Hope everyone comfortable with the T-table balance sheets. Now I'm talking about a balance sheet where assets and liabilities. Okay, all your assets. To understand what are all the investment category, look at your balance sheet, assets, asset side, and and we have your equity. So these are your liabilities. So for the financing category, we will look at liability side. From all your assets, pull out three kind of assets: cash and cash equivalents. Cash equivalent. Can you give me some examples of cash and cash equivalents? Like bank balances, fixed deposits, demand deposits. So this is defined as per IAS 7 cash flow statement. So cash and cash equivalents is the first asset we will pull out. The second asset, the assets that can generate return independently, individually, and independent from the other economic resources. So can you give me an example of an asset that can generate return by itself without depending on other economic resources?
நீங்க எதுக்கு என்ன அடிக்குது நாங்களே எந்த
Mr. Srinivas, can you please keep it on mute? Fine. Can you give me some example of an asset that can generate the return by itself without depending on any other economic resource?
FD kept in the bank.
Buildings, lands,
Investment property.
real
All
property.
investments. Okay, so let me give you two examples here. One, as you rightly said,
Bond.
investments in the bonds, investments in the equity instruments, investments in the investment property, which will give you the rental. So such kind of examples. So all those assets that can generate returns independently and individually from the other economic resources. And the third set of asset you need to pull out is the investments in joint ventures, subsidiaries, and associates. Okay. So these are the three assets we need to take out for the investment category. We will see one by one.
बाद में थोड़ा वॉश करके फिर ये.
Okay. For the liability side, make a classification of all your liabilities into two methods. All your liabilities can be classified into two. The first classification, the kind of liabilities incurred are presented on your balance sheet only because of rising finance. the classification to all other liabilities, meaning liabilities which have been erased or represented or presented on your balance sheet, not only because of rising finance. So the first one, can you give me some examples, the liabilities which will be presented on our balance sheet, and the reason is only because of rising the finance? Can you give me some examples for this?
This capital and
No, capital is not a liability. I'm not talking about
okay.
capital, other equity, retained earnings. No, I'm not talking about that. I'm
Debenture
talking about
issued?
liabilities.
For the payables,
Debenture
for the
issued?
payable.
It's like
Payables.
long-term borrowing, Satya.
Okay, so bank borrowings. So because of only rising of finance, I don't even use the long-term borrowings. I better use the bank borrowings or kind of a bonds issued or whatever. Like you can issue the loans obtained, notes issued. Supplier financing arrangements, or you can also have buyback of shares, the term loans. So where you have raised the invoice, raised the finance and the liabilities on our balance sheet. The other one, the other set of liabilities which are not because of raising the finance. Any examples? There is a liability. Exactly, perfect. Trade creditors. Anything more? Contract liabilities as per IFRS 15. Lease liabilities as per IFRS 16. Provisions as per IAS 37. So there are many other liability items that we present on the balance sheet, and this is not because that we took some loans or anything. This is not because of rising the finances. Okay. Now, keeping this in mind, we will see what kind of income and assets will be following. So number one, now we'll first discuss on the investment category, where we have taken out of all your assets. You may be having property, plant and equipment, inventory. We will have lots of other assets, but then our interest is only on these three assets: cash and cash equivalents, the assets that can generate return independent from the other economic resources, and the third one, investments in the joint venture, subsidiary and associates. First, we'll talk about investment category. So the cash and cash equivalents and the assets that can generate returns independently and individually and independently from the other economic resources. And then the last one is investments in the joint ventures, subsidiaries and associates. Fine. So can you give me, we are discussing about the examples also. All those as given the definition given IAS 7, what are all the kind of assets that should be classified as a cash and cash equivalents? Here we have already seen investments in bonds, investments in equity shares, or investment property itself, IAS 40. So these are all the assets that can generate the return independent from the other economic resources. The third one, investments in joint venture, subsidiary, associates. May I know, for these, you are preparing SFS, standalone financial statements. What is the method you follow? So you follow the cost method, fair value method, or equity method. Which one you follow? Which one you are bound to follow? I'm talking about IAS 28, not from the Indian accounting standards perspective, purely from the IFRS perspective. So IAS 28 is allowing you can follow either of them: cost method, fair value method, equity method, for the investments made in the joint ventures, subsidiaries, and associates. Okay, so all type of assets I brought and I have kept in these three buckets. Now, what kind of incomes or expenses or losses that we get from these sort of assets? From the cash and cash equivalents, what kind of incomes and gains we get? Maybe if you keep a fixed deposit, we'll be getting the interest. If we are investing, if in case maybe there are times there is a impairment losses, any capital appreciations, right? So we have identified the kind of income and expenses. Like for the assets, investments in the bonds will give you the interest, investment in equity will give you the dividends. There could be fair value gains and losses, impairment gains and losses. In the case of sale, at the time of derecognition, there could be some losses, some gains and losses. In case of any reclassification, gains and losses. In case of remeasurement, gains and losses, or maybe rentals, depreciation, lots of income and expenses for each of these category. Same is the case with the investment in the subsidiaries, associate, joint ventures. So we may be having impairment gains and losses. We'll be having the dividends. We'll have the impairment losses, fair value gains and losses, forex gains and losses, everything. Forex gain and loss also, including forex gain and loss. If it is a non-monetary, if it is a monetary asset, and if you are classifying here, you may be having a forex gain and loss. So we are talking about all expenses, all incomes, gains and losses that can be captured in our that the company will be incurring because of this asset 1, asset 2, and asset 3. Clear? So all the incomes and gains and losses, including forex gains and losses, fair value gains and losses, will be captured over here. Now, the question, where should I present this income and gains and losses? Should I present in operating category, investment category, or financing category? Where should I present these incomes and losses for these three assets?
Not depend on the nature of business.
Okay, perfect. Any more answers? So all your other assets which are not classified other than these three assets, rest everything, all the income and expenses, gains and losses will be taken to operating category, like depreciation on the PPE, impairment loss on the PPE. So impairment loss on the PPE. But again, if it is a revaluation gain on PPE, you will take it to OCI. So OCI items are intact. There is no disturbance with it. It will be intact. Only other than those listed in the OCI, other than those subject to investment category or financing category or income tax category or discontinued operations category, only this balance will be taken to your operating category. Fine. So for all other assets, straight away take it to your operating category unless covered by OCI. Okay, coming back. So this where you want me to take, perfect, sir. Like I take that suggestion. It should be depending on the nature of the business, and that's the right one. So now check what is the nature of your business. My business is very general business, meaning I'm into manufacturing, trading, or providing the services. Or otherwise, I can also say I'm not into, my business is not into investment into assets, be it your financial asset, be it investment property. This is not my business. I have a very regular common business. I don't have a business which is main core objective is into investing into the assets such as financial assets or such as investment property. Secondly, I don't have any business of giving finance to customers. This is not my business. I have a very common regular business. Fine. In that case, take all these income and expenses of these three assets, take it to your investment category. Clear? Investment category, investment category, investment category. Am I clear so far? Now the question, okay, what if my business is into investing in assets? What kind of assets are you investing? I'm investing in the associates, joint ventures, subsidiaries. So I'm a holding company. I'm a holding company. Now, where should I keep it? Fine. Since your business is associate, joint ventures, and subsidiaries, the first two are common for you. The cash and cash equivalents, just like any other regular business, you also show under investment category. This under investment category. But the last one, so which is the gains, the income and expenses from the assets such as investments in the joint ventures, subsidiaries, and associates. Now you see, you might be bifurcation. How are you classifying this asset? Are you following equity method or are you following cost method or fair value method? If you are following equity method, then again take it to investment category. If it is not, then you can take it to operating category. Why? Why, sir? Why they make us to if your business is into investing into the joint ventures, subsidiaries and associates, then any income from such assets like investment in joint ventures, associate subsidiaries, now not just blindly you can take it to operating category. Again, you see what kind of method you are using. Are you following equity method or are you following cost method? Incomes and gains and losses also include sharing profits of joint ventures, associates. So why do you think they want us to check the methodology? Okay, it is simple. Like if you are following equity method, you are not looking these particular investments are your inventory, or it's not like if you are making it subject to fair value method, meaning it's more like a tradable goods for you. So whatever the income and gains, you take it to operating. That is what your business is all about. But the moment you classify, you are using the equity method, meaning you are acting as an investor still. Although your business itself is investment in assets, you are also acting as an investor, proper investor with a long-term perspective view. So such kind of income and gains and losses, you still classify in investment category. If you are thinking it to be a tradable asset, then you may be taking it to fair value method. So any income gains and losses, you better take it to your regular model of operating category. That's what your operations is all about. Clear? Okay, fine. What about my business? Now the next one. My business is into investing in assets. What kind of assets are you investing? I am investing into the financial assets. Even investment in associate JV subsidiaries also financial assets, but now we are talking about other financial assets like bonds or maybe in equity shares, not like an associate. We don't have any control, significant influence, just like a normal equity investments. So those kind of businesses where they should take the income on cash and cash equivalents, they have to take it to the operating category. And here all that investments, all that income, expenses, gains and losses on the financial assets. So here we have taken investment, bonds and equity also. So on that they will be taken to operating category. And investments in associates is not their business, so here they will be taken to the investment category. Am I clear? Anyone want me to repeat? Yes, as is held for sale, we may be taking it to the fair value through P&L. So it is better you take all the incomes, gains and losses to operating category itself. Okay, there are two more businesses we need to discuss here. Next one, my business is to investing in assets, but what kind of assets? Investment property. Investment property, in that case, on the cash and cash equivalents, take it to your investment category because that is not your day-to-day business. On cash and cash equivalents, any income and gains and losses, take it to investment category. For the investment property, since we have an investment property here, we have taken investment property. So that gain and losses, we will take it to operating category. And investment in subsidiaries, joint venture associates, take to investment category. So depending on the nature of your business, these three assets income also will be segregated. And the final business we are more interested is I'm a banking company. I'm like more, my business is to giving finance to customers. Maybe I'm a banking company. Maybe I'm a finance lease supplier, finance leaser. I'm a kind of company where I provide the supplier financing arrangement. So the difference is, okay, I went ALLC, A Limited Liability Company, purchases some goods from the BLLC. Okay, so they have given two choices. Fine, I'll give you 3 months credit. Okay, credit period, I'll give you 3 months. So this is not a supplier finance. He just gave a credit period. Second model, he said, fine, you take the goods from me, but you pay me in installments. I'll give you say 2 years time period. You can pay me in installments. So here BLLC has entered into two contracts. The first one is a sale of goods and service, sale of goods. Second one is a supplier financing arrangement. Okay, these two are independent. So whatever the gain or loss on the sale of goods, you will take it to operating category. But on the supplier financing arrangement, you will be taking, you are acting as a finance. Your business now became, this is your trading business, and you have another business also, which is providing finance to customers. So now I'm talking about such kind of arrangements also. So maybe you're a banking company, you are a company who is providing finance leases, or maybe you are a company along with selling of the goods, you are also providing the supplier financing arrangements. So for such kind of companies, we are now talking about. Okay. So for them, obviously the rest two investments, like if they have investments in the investment property, it will not make any difference. You just take it to investment category, and investments in joint venture subsidiaries, take it to investment category. But these guys having income, expense, gain, loss on cash equivalents. Why do you think a finance business company will have a cash equivalents, cash and cash they left over, and they are making some incomes on that? Why do you think? They generally, the moment they have some cash, they have to offer it as a finance to customers. But then they're still holding it back. They are making some income on that. So where should I take it? Should I take it to operating category, investment category, or what? Can I have some response on this? Operating. Okay. Anyone think it should be investment category? So here we have to make a bifurcation. Why do you have this cash equivalent with you? Is this because of some adequacy capital ratio? If you need to give 100 dirhams of loan, you should at least keep some 20 dirhams with a bank. Any kind of some restrictions. Is this income related to providing finance to the customers? Yes, this has a direct nexus. This income has a direct nexus to my business of financing. Then you can take it to operating category. If there is no direct nexus for other set of, so other income gains and losses on the cash equivalents, you still have a choice. You can create your own accounting policy, like you can take it to other other operating category, or you can take it to investment category, up to you. So operating category, if it has a direct nexus towards the business, such as because of some legal restrictions, you are bound to keep some capital aside and you made some interest income on that. For all other income gains and losses on the cash equivalents, you can have your own accounting policy. Choice is given to us. Hope I'm clear. Okay. So the same thing I presented. Fine. Before that, so operating category is nothing but those items which will not be classified under investment category, financing category, income tax category, and discontinued operations category, and OCI. So it's a more like a residuary. Once we get in, the presentation is quite simple, like the way how we use it to present IAS1. Revenue less cost of sales, gross profit, and your regular operation expenses, you can classify either by nature or by function, up to us. So either way we can do it. Okay, then we started discussing on the investment category. Three assets we have taken: cash and cash equivalents, assets that can generate a return individually and independent from the entity's other resources. Then investments in associate, joint ventures, subsidiaries. We have seen the assets, like the examples of the assets, and what kind of incomes and gains and losses that we get. Hope I'm clear so far. This is what we have just seen. The same thing I'm putting it in the presentation style. Then it all depends on what kind of business we do. So these incomes, gains and losses, which category we need to take depending on the mode of the business. If your business is a regular normal business like manufacturing, trading, services, not you are not into investing into assets, and your business is not into providing customers the finance. In such case, all these income losses straight away take it to investment category. But if your business model is investing into the associate, joint ventures, subsidiaries, then the first two is fine, investment category. The third one, you should be careful which method are we using. Are we using IAS 20 as per IAS 27? You can use fair value method, cost method, equity method. If you are following equity method, then still those gains and losses will be taken to investment category. Others will be taken to operating category. Then entities having the main business of financial assets, this we have seen, and investment property. Finally, if your business is into financing to the customers, the second, third one is straight away to investment category. But then first one, you have to check what is the nexus, why I have this cash and cash equivalents in my balance sheet, why I am making this money. Is this having a direct nexus towards my business operation, which is the financing to customers? If it is so, you can take it to operating category. Other set, if there is no direct nexus, choice is given to us, operating category or investment category. Clear? If you want, you can post some questions on the chat box. I'm happy to take. Is disclosure of gross profit compulsory? Not exactly. I just presented it. Not that they have given gross profit is mandatory or anything. But the subtotals are mandatory. Operating profit is mandatory, or profit before financing and income tax. Yeah, we will share the PPT as well. So those 5 subtotals are mandatory. It has to be there on the five subtotals are mandatory. Rest everything is based on the aggregation and disaggregation rule. Clear? So now the second category, financing category. The moment we know financing category, we are good to go. Now that we know what are all components will fall under investment category, it all depending on the nature of business. Now we will see financing category. Income tax category is just like the way how we use it to prepare the tax expense from IAS 12, income taxes, income international accounting standard 12, that defines what all the components should be covered under income tax category. Then discontinued operations category, very less that we use, but then that will be flown from IFRS 5. IFRS 5 has given what all the incomes, gains and losses that need to be captured in the case of a disposal, discontinued operations or current assets held for sale. But here we will be focusing only on the discontinued operations. OC items also very much particular. Only 11 items will be coming, out of which 4 are reclassified to P&L and 7 are, 4 are not reclassified to P&L, 7 reclassified to P&L. Good to go. We'll see the financing category quickly so that we are almost completing the discussion. If you remember, what all the classification we need to do for the liabilities. Now we are shifting our focus. Previously, our focus was onto the balance sheet assets. Why? We were discussing about investment category. What we did from the whole set of assets, we pulled out 3 assets only to make the assessment. Cash and cash equivalents, investments in joint ventures, subsidiaries and associates. Was the third one? Investments in assets. What kind of assets? Be it financial asset or investment property. Basically, the assets that can generate returns independently and individually from the other economic resources. Okay. Then we are now talking about the financing category. For financing category, take all your liabilities, make a classification into 2. What are the 2 classifications? Anyone remember? The 2 classifications of liabilities. What are the 2 classification of liabilities?
The current
Okay,
and
external
non-current.
borrowing. No, sir.
Liabilities
Not
that are
current and
purely
non-current.
relating to
Contingent
financing.
liabilities.
No, you may be presenting as current and non-current liabilities, but now our discussion is on the what incomes, gains and losses of these liabilities should be taken to financing category, what components should be taken to operating category. Your presentation will be intact. You will show under current liabilities, non-current liabilities. But
Related
for
to fund.
only, sorry,
Related to the
Liabilities
raising
that are
of fund.
pertaining to
yes,
financing.
exactly. So those liabilities only because of rising of the finance, and all other liabilities, including the liabilities which are not only because of finance, will be classified under here. We have seen some examples as well. If the loans taken from the bank, or maybe by issuing the debentures, or maybe by issuing the notes, or even in case you agreed that I will buy back the shares and you created a liability. So previously you have taken the money, then it was share capital only. I still agree it was a share capital, not a liability. But then since now you agreed, yes, I'm going to buy back the shares, and you created a liability. So such kind of buyback shares liability. Okay, any kind of bonds issued. So all those things, and the supplier financing arrangements. You have taken a loan. This you bought the goods and you have also taken the loan from the same supplier. Supplier has two activities. One, he is giving the goods. Instead of a short credit period, he is telling you, okay, fine, I'm giving a supplier financing arrangement. You pay me in 2 years or 3 years of installments. So all such kind of loans on the balance sheet only because of rising the finance. And all other assets, all other liabilities such as lease liabilities or trade creditors, contract liabilities, IAS 37 provisions, all other liabilities will be under second category. Okay. Now, what kind of incomes, expenses, gains, and losses I may get because of these liabilities? The moment I have a liability, I may be paying interest. Fine. What other kind of income and expenses I may come up? Based on fundraising or not?
Interest
Yeah,
and
based on fundraising.
processing
Transaction
fees,
cost. Sorry, yeah,
yeah,
please go ahead.
loan processing fees.
Okay, transaction cost. Anything more? So IFRS 9, in the case of derecognition, at the time of derecognition, initial measurement, subsequent measurement. So there are multiple ways that there could be gains and losses that can come up with. At the time of derecognition or initial measurement, subsequent measurements are including interest expenses. So multiple incomes and gains and losses are possible with this. So derecognition, so this will be as per IFRS 9. Okay. Likewise, for the lease liability, I will create interest on lease liability as per IFRS 16. For the trade creditors, if the trade creditors is very good that he is giving me forgiveness, forgiveness is an income for me. So likewise, there are many income expenses that can happen because of other liabilities as well, like interest on lease liability, interest on provision. So provision as per IAS 37, we have to create based on the present value. For example, decommissioning is happening after 10 years. After 10 years, we are going to spend, say, 10 million dirhams. We will not record the provision at 10 million. We will bring it to the present value. And every year we will unwind. So unwinding discount. So there are multiple scenarios that can come up. Right. So this one, I'll make a bifurcation. This interest and expenses, I'll put into two styles. Sorry. I may take slightly 5-10 minutes extra so that we are fully covered. At least 70 to 80% of the major components are covered from IFRS 18. Okay, let me bifurcate such kind of interest and income expenses. So number one, interest expenses are income that we create, and because of change in the interest rate, income and expense is being recognized. Can anyone give me, there is a change in the interest rate because of there is an income and expense? Any one illustration, example, scenario? I have a lease liability. I created lease liability at 5%. Okay, now my estimations got changed. There is a revision. So my estimations got changed. Now my current incremental borrowing rate is 6%. So there are scenarios when you have to use the new rate. Right? Because of this change in the rate, there are some interest and expenses to be created. So all the interest and expenses, say for example, interest on lease liability and any kind of income and expenses because of change in the interest rate under one bucket, and all other expenses and income such as forgiveness income or any kind of derecognition income under second bucket. So total 3 we have. Am I clear, sir? You want me to quickly repeat? I'll just quickly repeat what we started with. Now our focus is onto the financing category. For financing category, my interest is on the liabilities side. The step one, what I did, I have bifurcated all my liabilities into two buckets. The first one, what kind of liabilities on my balance sheet just because of rising the finance, and all other liabilities I have taken. What examples we have taken, like loans taken, debentures, or maybe notes issued, the liability created for the buying back of our own entity shares, or we have taken a loan from the supplier through a supplier financing arrangement, not for the trade. So trade creditors will be here, supplier financing arrangement over here. So lease liability, the second category, lease liabilities, trade creditors, contract liabilities, provisions, and all. Then we started discussing what kind of income, expenses, gains, and losses I may incur because of these liabilities. In the first case, because it's a loan, you have to pay interest. And IFRS 9 requires us to make initial measurement, subsequent measurement, derecognition. So there are incomes and gains we need to recognize because of the IFRS 9. And transaction cost, all we have captured under one bucket. However, for the lease liability, we have made a bifurcation of the incomes, expenses, gains, and losses into two. The interest expenses are interest income and income expense because of change in the interest rate. So this is under category 1 and all other expenses under category 2. Why we are doing this, we'll discuss. So this is a holistic view we are giving it. Now, can someone please tell me where should I these interest income, interest expenses should be taken? Operating category, financing category, investment category. Where should I take these income and expenses?
Yeah, depending on the metal business.
Financing category, investment category, operating category. I have taken a loan, a bank loan for my working capital. I paid interest on my loan taken for working capital. Where should I be taking it to? Operating category or investment category? Sorry, operating category, financing category.
Financing.
Financing category. I taken a loan for property, plant and equipment for building construction. I paid interest on that. First of all, I'll be capitalizing if it is a qualifying asset, assuming it's not under qualifying period. So I'm paying interest on my constructed building. Should I take it to the operating category or financing category?
It is operating category because of the concession.
Operating.
Operating.
Operating category?
Yeah.
Okay.
Because of concession is not yet completed, right?
No, it's completed. If it is not completed, obviously we will be capitalizing itself. We don't even need to take it to P&L. We'll directly capitalize in the balance sheet, the PPE. So constructed asset. So we don't care what is the purpose of my loan. The moment I raised a finance, I incurred an expense. It again depending on the business model. I'm having a very general business. I'm into manufacturing, trading, services, or maybe other intellectual property rights. I have a different business. My business is not providing finance to customers. My business is not providing finance to customers. Okay. Or if my business is providing finance to customers, only two classifications. That's it. To make our life easy, only two classifications. Is your business a regular business which is not into the financing to customers, or your business is into financing to customers? If it is a regular business, blindly take it to finance category. The first two, but the last one, take it to operating category. What's the last one? Like I'll show. If it is purely because of the finance, all incomes, gains and losses, including transaction cost, processing fees also to be taken to financing category. Your other liabilities, if it is a interest expense, say for example, interest on lease liability, take it to finance cost. All other incomes and expenses, such as a gain on derecognition or a discount received from the trade creditor, a discount because maybe I'm expecting as my balance sheet 500 dirhams I had to pay to my trade creditor, but then he said if you pay early, I'll give you 100 dirhams of discount. So this discount is income. Don't take it to finance category, take it to operating category. So they made a bifurcation here. If it is an interest income or expense, take it to finance category. All other normal discount or forgiveness incomes and all, take it to operating category. Clear? Fine. If your business is into financing to the customers, the same principle does apply here, financing category and operating category, just like any other regular business. But here, be careful. Now, you have some interest income. you got some interest income. Why you got interest income? Because you must have given loans on your liabilities. Sorry, you have incurred with an interest expense. Question one, fine. Why there is a liability on your balance sheet? I took this liability. I took a loan from bank and I extended to another person. Okay, my business is financing to the customers. So why there is a liability on your balance sheet? I raised the finance from 5 people for 5% interest rate, and I'm using these proceeds to give finance to my customers at 7%. This 7% where I will take? Previously, we have seen if your business is into financing to customers, it will be taken to the operating category. Operating category. Now the question, you have taken some loan. This has a direct nexus to your business. Where should I take this expense? Operating category or financing category?
Operating.
So take it to operating category. Simple. Like now there is a liability on your balance sheet. That's absolutely fine. But check why this liability is on your balance sheet. You have taken this liability for financing to customers. Then any income gain or expense or loss, take it to operating category. If it is not, I have a liability, but this does not have a direct nexus, but I have a liability. Okay, fine. Enjoy. There is a choice given to you. It's up to you. You can create an accounting policy whether you want to take it to operating category or financing category. Fine. So there is a choice. Let me also present you. Now we are talking about the financing category. Two classifications, all the liabilities into two buckets. Liabilities that arise from the transaction that involve only rising of the finance and other liabilities. Mr. Gopal, can you please keep it on mute? Okay, we have seen the liabilities, the debt instruments, supplier financing arrangements. We have seen all these examples. Then what kind of income and gains and losses that we can get? Be it your transaction cost, be it your initial measurement, subsequent measurement, deregulation, a lot of expenses that can come up, incomes, gains and losses. In the other cases, only interest income and expense or an income and expense because of change in the interest rate and all other expenses like deregulation of the lease liabilities or a trade credit or giving a discount or maybe a forgiveness, all that under third aspect. So do I need to take this income and expenses under financing category or operating category depending on the business model? The first business style where I'm a general business, not into, so I will, so just for now, just ignore this one, investing in assets, just ignore this one. So my business is not into providing customer financing. So in such case, take everything to the financing category. Financing category. Sorry, the last one should be the operating category because any kind of discounts from the trade creditors or any kind of forgiveness. So all those items, deregulation of the lease liabilities should be taken to the operating category. Clear? But if your business itself is into main business itself is providing to the customers finance, then check why you have this liability. Is it having a direct relation to your business of providing finance to customer? Then all incomes, expenses, gains and losses take to operating category. Otherwise, you have given with a choice. You can choose the accounting policy, financing category, operating category mentioned clearly in the notes to accounts. The other two cases just follow like the other businesses, regular business. Please. Okay. Happy to take the questions now. We are almost, there are few other aspects like in the case of derivatives or in the case of hedge items, there's a slight changeover, but it may not be applicable for businesses at large. So we are not covering that today. So happy to take questions.
Yeah, thank you so much. Thank you so much, Satya. Thank you for your deep gratitude. Maybe Satya, before I invite members to ask the questions, we will take for 5 minutes. Can you share this presentation, as you said, in the chat box only so that those who wish to download, they can take it from here?
Okay, right away. One second.
Yeah, please, because then we don't know who attended and who didn't.
Ah,
Yes, so yes, Gopal, you have any
Yeah,
question?
very sorry, sir, that actually it was just a lapse on my part that the speaker was on, audio speaker. But
No
No,
problem, no problem,
that's okay.
Gopalji. No
That's fine.
problem.
based on what Mr. Satya Bharath had actually presented to us today, it looks that it's a highly judgmental issue, and then a lot of discretion has to be affected. It's not just by the rule of thumb of hit and miss over there. You have to see the main activity of the business and the category under which it has to be done. This has been beautifully explained today, but what about MPM, sir? When exactly it comes into the picture?
Management performance, management defined performance measures is used. Say, for example, I am for my company, I'm preparing only financial statements. Wherein in my financial statements, I'm already giving all the 5 subtotals in the statement of financial performance, the 5 subtotals which we were discussing. Then I'm not issuing any other document to any user, be it a banker or be it a public. I'm not issuing anything. This management defined performance measures, I need to include in my financials only when, in addition to my financial statements, I'm also giving some other kind of document. If I'm a listed company, quarterly basis, I'm informing my users saying that we have an EBITDA, although my profit is so low, my EBITDA is really good, or maybe my non-cash profit, I mean the profit with me, although I don't have the equity or the cash, an adjusted profit, if you are presenting an adjusted profit, or maybe if you are providing some kind of EBITDA which is not part of your statements such as statement of financial performance, uh, balance sheet and all. So it is, we are as a management, I'm bound to explain my financial statements itself. So wherever I use the word EBITDA, what I mean, so I how I'm getting I am calculating it, I'm talking about adjusted profits in a different statement, a public statement. What do I mean by that adjusted profit? I'm bound to mention that part also in the financial statements. Otherwise, I don't need to even touch that management defined performance measures.
Sir, can the presentation be sent to all the participants through the WhatsApp group over there through which we registered today?
Is there any WhatsApp group? Okay, one second. Let
No,
me also put.
no. There are multiple WhatsApp groups. Maybe Satya, if it's ready, can you share here only in the chat?
Yeah, just give me a minute. I'll do
Yeah.
that.
So, anyone else who has any question?
Yeah, if I can write to you personally through email, will you be able to send it to me, sir?
Yeah, sure.
Or
I'm trying
WhatsApp?
to share it right away, and I can also share it by mail.
Yeah, we are. Yes,
One
yes.
question actually, by the time you're sharing the presentation, you mentioned this management performance has to be mentioned in the notes to accounts. Does it require to be reviewed by the auditors also? I mean, the auditors are going to review
The moment if something, see, it will become form part of your financial statements. The moment you mention that management defined performance measure, it will be part and parcel of the financial statements. The moment it's part and parcel of the financial statements, auditor has no choice but to give his opinion on it. He has to give his comments if it is well made or if there is any kind of deviation that he has. So he has no choice but to give the opinion on it. Now, also quickly, like in case if you can also follow us on the LinkedIn, I'll be posting in my LinkedIn as well. Anyways, I'll be sharing it right now. If you also want to follow us on the LinkedIn for latest updates, that's also good. Here is your QR code.
Thank you so much, Srinivasa. Thank you to everyone for your beautiful notes. Satya is an expert and he really made it very easy. Yeah. So, anyone else who has any question? If anyone has a question, can you please unmute and ask?
Sorry, I could not take there are a lot of messages in the chat box. It would be very difficult to go back and check
we
it.
can,
Yeah, you can
that
unmute,
we
you
can,
can ask.
Yeah, that we can leave now. So we had participants today joining from Africa, the Gulf, India. Yeah, so at one point of time, this Zoom allows maximum 100 participants. We were full that time. Many of you have watched on the YouTube live streaming also. Thank you so much. Thank you to everyone. And yeah, so Satya, you have been able to share the once it goes there, you let me know, because there are so many messages coming in. Not able to keep a track of it.
I had to make few adjustments to the PPT.
Aha, okay. Maybe then what we can do, Satya, that though I trust that everyone has noted Satya's connect details. You can connect with Satya later on or with me, and we will share that. So I don't think we have any other questions right now. So Satya, your last words before we close for the day.
Thank you. Thanks for the opportunity. Thank you all the participants. I'm sure you are already gearing up for the IFRS 18 presentation. And don't think that it is applicable only from of course, it's applicable from 1st of January 2027, but even our 2026 records also, when we go presenting 2027, a comparative always required. When we are presenting the comparative, we have to keep our 2026 in such a way that it is presentable in the IFRS 18 style. So in 2026 also, you can keep your chart of accounts and the style that it is getting presented, or the mapping. The mapping, as you can see now, operating category is the easiest one, because our focus will be only onto the investment category or financing category. Income tax category, from the ages we know it, so those items will be still continued. OC items is the same thing. Discontinued operations, same thing. Only investment category, financing category, if you can get hold on to, rest everything will be just like the way how it is. The mapping can be accordingly made. So thank you everyone for your time and patience.
Sir,
thank you, Satya.
Sir, we would also, I will also request through Pradeep ji that we should have the next IFRS also, 19th and 20th, which is going to be issued in the later part of the year. You should conduct a workshop in the large interest of all the members interested.
Certainly we will plan. So we have a couple of sessions scheduled for AI and for taxation. Taxation is also of a deep interest. So we'll keep you informed on the sessions which are coming up. Thank you for your encouragement. Have a wonderful Saturday, wonderful weekend ahead. Great gratitude to Satya once again, and to all of you as the participants who had been very patient, very actively, who you participated in this session, and that I think must have made it very interesting for Satya. So take care, have a good lunch, good rest, good dinner, take care, bye-bye. Bye. PPT will be shared to you separately. Bye-bye. Take care.
Thank you so much, Pradeep ji. And thank you so much, Satya ji. It was worth spending a Saturday for learning this new IFRS, which you simplified it.
Thank you.